Hello guys, welcome back to Zodiac Trader. So in the last episode, we have go through the very basics of option trading. We have to understand and master all of this concept in order to become a proficient and profitable option trader. So you have to pay attention to the details. So today, this will be the episode number 2. Let us begin. So, to continue, today we talk about the equity options. So, this is how you understand your option contract. Because today we are trading all electronically. You will have a brokerage account. You put your money in, you wire your money from the bank, and with that account, you will send buy and sell order directly to the brokerage. So the brokerage platform will help you to buy or to facilitate the options. And with every given option contract, you will see different specifics on that options. For example, you will see XYZ Incorporation, which is the name of the company. So it is sometimes might not necessarily become a company name. In some cases, might be ETF or etc. So basically that means the underlying equity for the options. So you have 17.75, which is the closing market price of the underlying equity. And then you have MAR, which stands for the options expiration month. So typically you see March, September, and December, you see many different expirations. It really depends on the liquidity of the contract. So it's very important for you to choose the right expiration date because if you have chosen the wrong expiration month, your option contract is going to expire very, very quickly. So here you see 17.5. This is the exercise price for each series. For 17.50p, that means with that P, that means the option is basically a put contract. So 3.0, 3.80, which is the closing bid price for each XYZ option, expressed as a per share price. 4.05, which is the closing ask price for each XYZ option expressed as per share price. 3.95, which is the last sale price, which is the last premium traded on an option contract for the day expressed as a per share price. For example, the 3.95 figure for the XYZ March 17.5 call is the last sale price for this series on the trading day in question. So more about equity option quotes. You see the OPINT, which stands for the open interest. And the open interest actually means the total number of option contracts in the series that are currently outstanding and have not been closed out or exercised. So it kind of shows you the option flow. So it shows you how much of the options are actually existed in the market, which is a very, very useful indicator. For example, the figure 1595 refers to the open interest for the XYZ March 17.5 calls. The figure 110,404 refers to the open interest of all series of XYZ options, including the series that did trade as well as the series that did not trade. So it doesn't matter if it's trading or it has been traded, or it doesn't matter if the option has opened or just been closed out yet. All these options will be recorded inside of the open interest number. So here, option strategies for individual and institutional investors. So basically, when you trade option strategies, it basically is like playing with Lego. Okay, so in the future, in our episode, you will learn more about how to master the assembling of these Lego. Okay, so basically, you have different options, you have different legs, and you put it together, and it's going to become a very complicated strategy, but it has certain use, which is the beauty of option trading. It helps you to smooth your profit and also helps you to smooth out your max drawdown. In a sense, you're not taking so much of risk, but you're getting a better return. So basically means option could be a very good risk management tool. So range and complexity of trading strategies are practically limitless. 8 option strategies used by individual and institutional investors will be discussed involving either long or short position in an XYZ call or put option. Strategies will either be speculative or risk management based on exchange trading options. At times, the option position will be the only part of the strategy, but in other cases, the option position will be combined with a position or expected position in XYZ stock. There are other more complex strategies that are commonly employed. So the strategies assume that it is currently June and that XYZ Incorporation stock is trading at $52.5 per share. If XYZ Incorporation was a real company and it had options listed on the stock, there would typically be a variety of expirations, dates, and strike prices to choose from. See 4 options listed in the table. General assumption. It is currently June and XYZ Incorporated stock is trading at 52.5 per share. So 4 options on XYZ Incorporation stock trading at 52.5. XYZ Inc. has options listed on its stock with a variety of expiration dates and strike price to choose from. See table. So option style, you see call options, which is going to expire by September. So the strike price is $50 and the premium is 4.55. So the other is the December expiration with the $55 of strike price and $2 premium. And you see September expired put contract with a $50 strike price and $1.5 premium. And December put contract with 55 as strike price and 4.85 premium. So for simplicity, commissions, margin requirements, and dividends are ignored in all of the examples. So keep in mind, if you are trading a real account, it does matter for you to actually, take consideration of these commissions and margin requirements into account. So the first strategy, the very basic one, is that you buy and call options. So reason to profit from an expected increase in the price of the underlying stock, you have a speculative strategy that relies on the fact that the call option price tend to rise as the price of the stock rises. So the challenge would be selecting the appropriate expiration date and strike price to generate maximum profits given the expected increase in the price of the stock. So if you are very positive of the stock underlying, you could buy a call options. That's a very simple strategy to perform. If you win, you have unlimited earning, but if you lose, you have limited amount of money to lose. You'll be, losing. The maximum loss you're gonna have is the option premium, the option fee that you have paid for the call option. So there are challenges that you should select the appropriate expiration date, and then the time is not on your side, and you need to be specific on your strike price. So because if you have chosen the wrong strike price, or say the stock doesn't really end up somewhere near the strike price, you still lose money. So two ways to realize profit on call options when the underlying increases in price. First, investors can exercise the option and buy the stock at a lower exercise price. Second, they can sell the option directly into the market at a profit. So the calls may be bought to establish a maximum purchase price for the stock, or to limit the potential losses on a short position in a stock. Buying options act much like insurance, protecting the investor when the stock price moves higher. So remember, in our first lesson, in our first course, we talked about the car dealer example. When you're buying the call options, it's like you have paid 1% of the money to secure the right to purchase the car with discount. So you can either choose to forsake or give up this right, or you can choose to exercise it. It's your right as an option buyer. So strategy number one would be buy calls to speculate. So an investor buys 5 XYZ December 55 call options at the current price of $2, pays a premium of $1,000, which is $2 multiplied by 100 shares multiplied by 5 contract to obtain the right to buy 500 shares of XYZ Inc. at $55 a share on or before the expiration date in December. So the options that are out of money, the strike price is greater than the strike price of 52.5, and the $2 premium consists entirely of time value. So that means you're buying an out of money option. Why? Because when the price is rising, if you're buying an out of money contract, it's going to be cheaper. But then it has no intrinsic value, which means time would be a greater enemy, because your time value will go out very quickly because you have no intrinsic value. Your contract would be exposed and then quickly go worthless. That's the case. So for the speculative investor, intent to the call of the call purchase is to profit from an expectation of a high XYZ stock price. In a sense, you're trying to long the stock price. So the call buyer will want to sell the 5 XYZ December 55 calls before they expire, preferably at a higher price than what was paid for them. But if the price of XYZ shares rise, the price of the calls will likely rise, and the call buyers will be able to sell them at a profit. Of course, the call buyers faces the risk that if the stock price does not rise, or worse, it falls. For example, if by September the price of XYZ stock is $60, the XYZ December 55 calls will be trading for at least their intrinsic value, which in this case is $5. Since there are still 3 months remaining before the option expires, the premium will also include some time value. Assuming the calls have $1.7 of time value, they will be trading at $66.7. Therefore, the investor could choose to sell the option at $6.7 and realize a profit of $4.7 a share, equal to the difference between the current premium minus the premium paid, or $2,350 total. And how do you get this number? $4.7 multiplied by 100 shares multiplied by 5 contracts. However, XYZ shares are trading at $45 a share in September. The XYZ December 55 calls might be worth only $0.25 at this time, and indeed, at all other times before expiration. The investor will have to decide whether to sell options or hold on in the hope that the stock price and the option price recovers. If the investor sells at this time, a loss equals to $1.75 per share, or $875 in total, which equals to 1.75 multiplied by 100 shares and multiply by times 5 contract with results. Selling before expiration allows the call buyer to earn any time value that remains built into the option premium. Also, the option buyer gives up any chances of reaping any further increases in the option intrinsic value. The call buyer's outlook for the stock price plays a crucial role in the decision. So, you can also perform the strategy number 2, which is that you buy call to manage your risk. Essentially speaking, you are buying an insurance contract to protect yourself. So investor can buy call options to manage risk. For example, a fund manager intends to buy 50,000 shares of XYZ stock, but will not receive the funds until December. So buying 500 XYZ December 55 call option will protect the fund manager from any sharp increase in the price of XYZ above $55 strike price, because they will establish a maximum price at which the share can be purchased. For example, if XYZ shares increase to $60 just prior to the expiration date in December, the options will be trading for their intrinsic value only, in this case $5. And how do you get that number? $60 minus $55. You get that $5 of intrinsic value. Since the call buyers now has the money to buy the shares, the calls can be exercised, at which point the call buyers will purchase 50,000 shares of XYZ at the strike price of $55. Thus, the call buyer's net purchase price is actually $57 per share, considering $2 paid for the option. But if XYZ shares are trading at $45 just prior to the expiration date, the call buyer will let the option expire and will buy the shares at the going price of $45 each. So, the investor's effective cost is $47, which includes $2 paid for the calls. So, okay, you can also sell call options. It actually means that you're selling call, or say, writing call options. So when you are selling call options, you are behaving just like an insurer. So investors write call options primarily for the income they provide. For example, the premium, which is the option price, which is the writer to keep no matter what happens to the price of the underlying assets or what the buyer eventually does. So as an option seller, you should act as an insurer. So you have the obligation to deliver at all costs. So call writing strategies are primarily speculative in nature, but it can also be used to manage risk. So 2 classifications for call option writers. So you have covered call writers, people who owns the underlying stock and will use this position to meet their obligation if they are signed. So in a lot of situations, as for typical call writers, cover call writers, they will have 100. Say they will have 100 stocks as the to hold on hands, and they're also selling, for example, 2 to 3 contracts of calls. So if anything bad happens, say the stock price hits so high, so they will have to actually perform their obligation. They have to buy back all these stocks with the market price and bear with the losses, because they already own some of the underlying stock. So it means they are partially hedged or fully hedged. They could just give out the stocks that they're holding to people that are buying the calls from them. So as for naked call writers, means that you're selling calls, but you do not have any stocks or underlyings on your hand. So that means you do not own the underlying stock, and if assigned, the underlying stock must first be purchased in the market before it can be sold to the call option buyer. So that's the case. When you're selling call, you say that you're selling call at $20, that you do not expect the underlying price go above that $20. You want the price to go below that $20 to obtain the option premium. So, but in the worst situation, the market bounced up and the price quickly jumped above that $20. What's gonna happen to you is you have to buy back the stocks and whatever the stock price is currently at. For example, the stock might be trading at $30. So now you have to buy back $30 stock. You have to buy back, if you're selling one contract, you're buying back 100 shares. If you're selling two contracts, you're buying back 200 shares. That means if you're buying back 200 shares, that you'll be bearing $1, $10 per share. That means you are bearing $2,000 in total as your losses, because you expect, when you're selling call, you expect the price to go below that $20. So call option buy will only exercise if the price of the stock is above the strike price. A signed naked call writer must buy the stock at one price, the market price, and sell at the lower price, which is the strike price. So naked call writers hope that this loss is less than the premium they originally received, so that the overall result for the strategy is a profit. So since all exchange traded stock options have American style exercise feature, call writer and put option writer face the risk of being assigned at any time prior to expiration. So prior to expiration, it is more advantageous for call buyers to sell their options rather than exercise them, because by selling, they receive the option's time value as well as its extrinsic value. So only the intrinsic value is captured when an option is exercised. So the chance of being assigned before expiration is not as good as one might think. Though this happens, particularly when the time value is small, the option writers must be aware of this. So you can perform as a cover call writer. You can perform the first strategy as cover call writing. So assume an investor writes 10 XYZ September 50 call options at the current price of 4.55. So the investor receives a premium of $4,550, which means 4.55 times 100 shares times 10 contracts. So it takes on the obligation of selling 1,000 shares of XYZ Inc. at $50 share on or before the expiration date in December. Because the options are in the money, the strike price is less than the stock price, and the 4.55 premium consists of both intrinsic and time value. Intrinsic value is equal to $2.50 and time value is equal to $2.05. So if the investor already owned or purchased at the same time as the option was written 1,000 shares of XYZ, the overall position is known as a cover call and, for example, cover call writer. So at the expiration in September, the price of XYZ stock is greater than $50. Options are in the money. The cover call writer will be assigned and thus to have to sell stocks to the call buyers at $50 share. So from a cover call writer perspective, however, the effective sell price is 54.55 because of the initial premium of 4.55. But if the price of the stock expiration in September is less than $50, the cover call writer will not be assigned and the option will expire worthless. Call buyers will not elect to buy stock at $50 when it can be purchased for less in the market. The cover call writer will retain the shares and the initial premium, thus the premium reduces the cover call writer effective stock purchase price by $4.55 per share. For example, if the cover call writer bought the XYZ stock at $50 and the options expire worthless, the cover call writer's effective purchase price is now $45.45, which is $50 minus 4.55. So in this sense, writing a call slightly reduces the risk of owning the stock. So it could be viewed as an alternative strategy of owning the stock and just wait there Okay, so the strategy number 2, naked call writing. So assume an investor writes 10XYZ September 50 call option at the current price of $4.55. If call is not already owned, which is makes you a naked call writer, which I highly not recommending any like option beginners to do, is to write naked call. That is definitely not recommended because it is really risky. So the best the rest naked call writer could hope is that the price of XYZ stock will be lower than $50 expiration. In this instance, the call will expire worthless and the naked call writer will earn a profit equals to $4.55 a share and the initial premium received. This is most that these call writer can expect to earn from this strategy. The reason why a lot of people doing naked call writing is because most of the time the stock goes sideways. So if you find a good strike price and you sell naked call right there, and there is no strong momentum at all, like percentage wise, you have greater chance to make that premium. Okay, but you're also for that $4, $5, but you are also like you're essentially risking your neck to get that $5. So if any market trends going on with the certain stock, and the price is going, either going upward or downward, you're suffering losses. That's the case. So if the price of the shares increase, the naked call writer will realize a loss if the stock price is higher than the strike price plus the premium received. In this case, $54.55. In this instance, the naked call writer will be forced to buy the stock at the higher market price and then turn around and sell them to the call buyer at the 50 strike price because you're selling the call. You are writing a call and someone is buying the call from you. So that's why you are, as an option seller, you are obliged to sell them the call. So that's why you have to bear all this risk for that tiny $5. So when the stock price is greater than 54.55, the cost of buying the stock is greater than the combined proceed from selling the stock and the premium initially received. So for example, if the price of the XYZ rose to $60 at an expiration, the naked call writer would suffer $10 loss on the purchase and sale of the shares. You buy at $60, you sell at $50. So this loss is offset somewhat by the initial premium of $4.55. So the actual loss is $5 a share, $5.45 a share, or $5,450 in total. That is scary. So that's why you need to be extremely careful when you're selling calls. And how do you get that number? 5.45 times 100 shares times 10 contracts. So in that case, we have finished about naked call and buying long call, and we also talked about selling cover calls, and that's all for today. And in our next episode, we are going to explain more of option fundamentals. So thank you guys for watching. Please subscribe, click that like button for me, and I will see you in the next one. Goodbye.